Hey guys, we are coming back with another episode of the Deal Finders podcast, and you want to sit down for this one, grab a pen and paper, and probably a calculator, because our guest, my friend Aaron, is going to go through what mortgage rates look like. What happened in 2008? What's happening today? How do we relate? And how do we make money in this business using what Warren Buffett said was the best investment instrument known to man, being the 30-year mortgage? That's probably not his direct quote, so look that up if you want to quote it from Warren Buffett. But listen, this podcast is intense. It's deep. You want to look at it, watch it for the graph, go to the YouTube channel for that. Otherwise, you can listen to it here and take some notes. So we'll see you over there. Well, Finders, we're back here with a great friend of mine and a really smart dude in the finance world, Aaron Chapman, all the way from across the country, but he knows so much about this financing world, interest rates, the markets, the ups and downs, and really why it does and why some of it doesn't matter. So, Aaron, I want to jump right in and really try to get as much info from you as we can for people getting started in real estate. So let's give them your backstory. Tell us a little bit about who you are and where you are, and then we'll dive right in.
Right on. Well, I appreciate that. It's one, good to see you. We haven't seen each other face to face in a while.
Yeah.
And then anytime I can just rip open the skull and just dump data on people, especially the new investor trying to understand how do you get started, how do you get things done, it's a big deal to me. So I appreciate the opportunity.
Yeah.
Backstory. I mean, I come from a different world than what I'm in right now. You know, I grew up doing the cattle ranch thing, then running heavy equipment, worked in the oil fields of Wyoming, worked in the mines. I got to a point where they shut down one of those projects. I had to find a place to go, and thought it'd be easy to find a job because I had all this experience, but that was the problem that I had, was I was overqualified for everything. They thought I was overqualified for everything I applied for.
Yeah.
It got to the extent that we were so destitute that I was applying for a $10 an hour truck driving job and had left my house with a coupon for free diapers because I was just completely out of money. I was overdrawn. Wow. And so I found myself, one, getting turned down again, overqualified, and leaving there, going to a grocery store to find those diapers with that coupon, and getting the gas light to come on in my truck. So didn't know how long I could go, so I pulled up to a gas pump outside that grocery store, said a quick prayer, swiped my debit card, and I got a decline because of the overdrawn account. Yeah. So I rifled through the truck looking for some loose change, maybe $1, and I found a couple of coins, locked my door, and I started walking that parking lot for a couple hours. Now, this is late 1997. This is when people still carry change, and a gallon of gas is like 89 cents.
Yeah.
So I found enough change to get those 2 gallons of gas to get. I went inside, got that corresponding diapers. I'm heading out with my head down, making sure nobody saw my look on my face, the stress that I was under. Yeah. And I heard my name called. There was a good friend of mine by the name of Keith, used to run an office where I ran heavy equipment before. He asked me how things were. I literally just kind of glazed over everything.
Yeah.
And he said, "Hey, let's go to dinner." I told him, "I can't afford dinner." Yeah. So I'm completely broke. And he's like, no. I got a gift certificate to Red Lobster. We ended up going to Red Lobster, and he introduced me to the mortgage industry in 1997. So I cut a foot off my hair, shaved. My mom bought me some business clothes, and I started as a telemarketer. And that's how it all got going. Now I work with real estate investors all across the country. I've done as much as 1,300 to 1,500 transactions a year just for real estate investors. We focus on helping people get started and understanding what's going on in the markets. And, I do business in 30 states. I'm ranked in the top 1% of the industry. Yeah. It's all from just staying at it, and understanding things better than anybody else.
Wow. That is incredible story. I did not know that you were, destitute on the doorstep of like nothing left. Obviously, I didn't know you back then. I just know you for your brilliance right now. It's like, we all have that backstory, right? We all have to start somewhere. It's amazing how the Lord can shake us and wake us at the right time.
And that's the thing. People don't look at that, right? It's like, I put everything in God's hands on that one, because 1 minute later, if it took me 1 minute longer to find those coins, I wouldn't have seen Keith.
Yeah.
If I found that 1 minute faster, I would have seen Keith. The timing was absolutely perfect. And so, that's something I was talking about just this last weekend. And I actually saw Keith again for the second time since that time. And he came over to the house and we had dinner, and he seemed to be a little bit discouraged. Like, it's like, I'm not getting anything. I said, dude, you got to understand the impact you've had. And I shared that story again with him because he didn't really understand the gravity of what he did. I'm like, if you're in the right place at the right time, doing the right things, you have an impact. I said, it wasn't the impact you had on me. the impact on the thousands of real estate investors who have started their business because of what I've introduced them to and how I've helped them get confidence in the market. And then all the opportunities like you, Andrew, bringing me onto a podcast. That's all from teeth. You don't bring on a guy who is just working in the mines or running heavy equipment. I wouldn't be here because of a guy who happened to just be right there. I think he was by a divine intervention. Also, the fact that my prayer was answered by not answering my prayer, by running that debit card, think about that.
Yeah.
All those things had to line up perfect. And here I sit today to talk to you people because of that.
Yeah.
When you start stacking all those things up, it tells me there's a reason why I'm sitting right here.
It is. And your passion for sharing and for putting it out there, it comes from that. I mean, I just know it. That's, where the backstory comes from. And so tell us about that getting into your telemarketing. For me, one of the hardest things there is, these cold callers out there, I give them so much credit for getting on the phone and just dialing after dialing. How did you get started back then? And what was that first kind of thrill? What was that first deal like?
So the telemarketing is miserable. You go from being underground, drilling and loading up all your holes with explosives, blow it up, stepping around the corner, firing that off, digging it out and doing it again. That was a phenomenal job. So several hundred feet underground with a drill machine and a loader and a couple cases of dynamite. Who wouldn't like that job?
Awesome.
Well, then you go to sitting in a freaking polo, and I hate polos. And I'm sitting there dialing off of a list, trying to explain, interest rates have gone down, we do a refinance, but it hardens you to be able to talk to people. I was a very, very, very shy person growing up. I had to develop into a new persona to be this person. What was interesting, the person I was on the phone was different than the guy that people saw. And so as I evolved, I started closing deals. I was meeting people face to face, because back then you met people face to face a lot. I didn't match who they heard on the phone. So I had to overcome that too. So now as you see the person I am today, I match who I am and try and just I'm just who I am. If that's a problem for you and you walk away because of me being the real Aaron Chapman to you, then good. We weren't meant to talk anyway. I would have wasted a lot of time trying to earn your business when I never earned anything. I would have been lying to you with my appearance or my speech. Now, did you get what you get?
Yeah.
So it was really, really tough. And, I worked getting 10 leads. And then once I got those 10 leads, I convinced the boss to let me work those leads. They introduced me to another loan originator, help train me. And it was a thrown in the deep end of the pool kind of stuff. But here we are, right? Years later, most of those guys aren't even in the industry anymore.
Right.
All the people I was around. But what I do is I learn from different guys within the branch, had different traits. And you start picking up the traits these people, what they can do and what they get away with and how they analyze things. And so I started taking the things that were most valuable to me and incorporating it into how I ran my personal business. Yeah. Now I have a team of, I think it's like 13 people that we go out there and we just build deals.
I love that. And so, y'all, if you're listening to this podcast, you can watch it and you can see what Aaron's talking about. He has probably, 18-inch beard there? It's
something like that.
Yeah.
Usually I'm running twin braids. Today I did the single braid just because. Yeah, so that's a story in itself, right? 2008, we all went through the crash. We experienced that whole mess. I was in the industry, went through the crash. I got in a motorcycle accident August 8th of 2008. I couldn't grow a beard. I always had a goatee. I had a spot that wouldn't grow in here on my right side. Well, I got in this accident. It's 12:24 in the afternoon on August 8th in Arizona.
Wow.
So I had to skipping down the freeway, tore up my face, shattered my legs, my right lung eventually collapsed within a couple of days, a bunch of broken ribs. I had one good arm, one good limb. That was my left arm. Well, I woke up and I had a major, major head injury to the extent that my memory would recycle every 3 minutes. So I was like in a new place every 3 minutes.
Wow.
My long-term memory was there. My short-term was just completely screwed up. So I'd wake up and like, where am I at? But then once things started to stick, I realized I had a full beard as I'm in the hospital. I'm like, cool. Because what happens is it tore up this side of my face and it replanted everything. So I decided to leave the beard until I learned how to walk again. Once I started walking, I kept it at that length. Well, I ended up going to an event. It was a mastermind event. And I meet up this guy, Ron Phillips, and he walks in. He had a full beard, shaved head. I'm full beard, shaved head. He goes, my beard was longer than yours yesterday. Guys got to measure everything. That's our thing.
Yeah.
Well,
okay. Yeah.
I'm like, mine was longer yesterday. I trimmed it to come here and look decent. I said, here's the deal. I won't trim it till I see you again. Now, normally I would see Ron every 3 to 6 months. I didn't see that man for 5 years. So That's why the beard is this long. Got all the way down to my waist. I finally got on my YouTube channel. And I took my knife and cut it in half.
Yeah.
I got to about right there, but now it's a brand. I got to leave it.
Yeah, you can't get rid of that now. It's awesome. So, yeah, and it's a brand, and you're branding yourself, and now in this age and in today's marketplace, so important to keep that brand and to be authentic, which you were doing from the beginning, right? You're not starting this authenticity trick, but you've been doing it from the beginning, and I think that's one of the reasons you stood out from 97 to today in a mortgage industry that, frankly is full of people, full of options. But what makes you able to help investors today? I have an idea, but what do you think that is of how you're able to get to 30 different states and, would you say, 1,500 transactions?
Well, it's peeling back the layers as to what is really important in a real estate investment transaction. What you have for the last 13 years is a heavy focus from the real estate investment world on what they refer to as the cash-on-cash return metric and cap rate and these things. Now, albeit important metrics, but not the end-all be-all. They're so focused on that, like, if I'm going to buy this house, it's got to create X amount percentage of cash-on-cash return, failing to look at all the other idiosyncrasies associated with the transaction. So what I started to do is really, in 2016, start telling everybody who is focusing on this metric, like, guys, that's going to bite you in the ass. That's all your training is, what's the cash-on-cash, what's the bottom line, and not looking at all the other bottom lines. You're going to get caught into painting yourself in a corner, not being able to sell houses when the rates go up. Everyone's like, well, the rates aren't going to go up. Like, why are they not going to go up? There's guys literally arguing with me that the rates aren't going up. There was one group out in, where were they at? In Kansas City. Like, they were directing most of traffic to go to, like, these guys had a 10-year interest-only deal that was a 20-year amortization because the rates are always going to stay low. I'm like, do not do that. Oh, wow. Do a 30-year fixed and get these low rates while you can get them. And it was a battle, and so many people locked themselves into those deals, and they shouldn't have. And now look at what they're dealing with. What they didn't realize, many of these people got into the market after 2010, got into real estate investing and all that kind of stuff. They didn't realize what was going on before. You look back on the history of interest rates, the average interest rate was about probably 9%, 9.1% from when they started doing the 30-year fixed up until 2009 when the Fed started doing quantitative easing. Now, quantitative easing was something that where the Federal Reserve, after the crash of 2008, nobody wanted to lend their money. Right. You see the movie The Big Short, explains what happens and how nobody wanted to get involved in the mortgage-backed securities because of how much money was lost. Our money doesn't come from the Fed. Well, it didn't before. It doesn't come from the T-bills. Everybody follows the U.S. Treasury, the 10-year, to see what rates are doing. It doesn't come from the Fed lowering interest rates. It doesn't come from your banks. It's a big pool of money from hedge funds to mutual funds to retirement accounts, throwing a big amount of money in there and then lending it out for a flat rate of return for 30 years. It is guaranteed by the person's promise to repay, which is the note they signed, and the lien against the property that you could take the property as an asset if they fail to pay. So that's the security of this instrument. Well, when you look back at 2008, 2009, interest rates, it didn't matter what the rate was. Nobody was lending. Yeah. So the Federal Reserve came out between Ben Bernanke, which is the chairman, and Hank Paulson, who is the Secretary of the Treasury, says, we're going to do quantitative easing, which we're going to take money from the U.S. Treasury, filter it through the Federal Reserve, and buy into these pools, U.S. Treasuries, and to the mortgage-backed securities and corporate bonds to stimulate the economy. We're now going to lend money, and then we're going to invest the U.S. taxpayers' money, then reinvest the earnings from people paying the interest to keep building this up. So what they did, I will screen share here with this, and I got to show all this information. Can I share? I think I can.
You should.
Yes, I can. So now it needs to get me to select the tab. Here we go. So what I'm showing you is here, to let me know when it pops up.
Not yet. So guys, go to the YouTube channel, Deal Finders. I think it's just YouTube/Deal Finders, and you'll find us there. We'll put the link in here so you can look at this graph, and it is live. I can see it, Aaron.
Yep, and it's a big, big, big graph. So what this illustrates is the history of the mortgage-backed security from all the way back to May of 2008 up until today. And what it is it illustrates the amount of capital going into the mortgage-backed securities and how much is coming out of it. So the higher it goes means there's a higher supply of money, lower interest rates or cheaper costs. just like anything, supply and demand. The higher the supply, the lower the cost. The lower the supply, I mean, the scarcer it is, the more expensive it becomes. That's why rare items are so expensive. So what I have here is a lot of lines on here. Every one of these lines you will see represents 1 week's worth of trading. If it's green, it means it was traded up, money flowed in there that week. If it's red, money flowed out that week.
Okay.
What you'll see is this yellow line I drew to the far left, and it shoots all the way to the right. What that illustrates is the day the Fed announced quantitative easing, saying, today we're talking about investing all this money into the mortgage-backed securities pools. Well, it jumped way up immediately because the entire world says, if they're going to start investing billions of dollars in here, we want to invest in. So money started to flow in. You get to an orange line above it. That was the day they invested in it, which was January 1st, 2009. So end of November 2008, they announced we're going to, and then it jumped significantly because of all the other people jumping in, and then the Fed started investing in every single bit of this that you will see, this big bubble of capital, all happened after 2008. Well, then you get to the end of 2021. It was October 2021 where the Fed said, we're going to do quantitative tightening. And look what happened. The bottom fell out of it. It was like a cliff, just dive off. Money left that fast. Interest rates started ratcheting up really, really quick. And then it hit a bottom point, and then it started to rebound. Well, it was interesting. Everybody kept asking me way back here in February of this last year. I'm going to zoom in. Let me see here.
And this is why I think you are like the leader in this. You have this data, but also you know how to interpret this data for investors to take action and make smart business decisions.
Yeah, and understand what's going on in the market and why we worry about these things. So way back in here, February of last year, 2023, people ask me, well, when are the rates going to go back down? Like, I don't believe they're going to go back down. And that's when I said, well, I'm going to expand this chart out as big as I can get it. I'm going to go back to 2008. The biggest pivotal moment in the history of the interest rates was when the Fed announced quantitative easing. So what day was that? And that's why I drew that line. Now, that same line right here represents the price point of the security the day that the Fed announced that. And I decided in early 2023, I got a YouTube channel. I do a YouTube update on the markets twice a week. And I announced it to the whole world. I believe when we get below this line, because you can see it was a struggle, every bouncing above it. But when we finally break below it, we will never get convincingly above it unless the Fed does quantitative easing again. The market itself, or the average places investing in mortgages, don't see enough value in the mortgage to put more money in than that particular price point, meaning our rates won't go lower than that. And look what happened. We got down there to our highest point in interest rates October of this last year. Mm-hmm. And then they started talking about how weak the economy was. This is all a lot of, I'll just be blunt, guys, forgive the word, but a lot of bullshit of them talking about how strong the economy is, how jobs are awesome, the administration is doing so much for the American people when we know damn well they weren't. And then the information started to really get leaked out in the mainstream media. It's like, jobs really suck. Our economy's in a lot worse shape. And look what happened. It started to come back in where all this investment started coming in from every other place. Like, the economy's in a lot worse shape than we thought. Yeah. Which they all knew that. I don't know why they were listening to the news. Now they started pulling money from all their other sources that put it into something that's going to have a flat rate of return for now. And they shoved it all in. And then where did it hit? It hit that price point from 2008, the day they announced quantitative easing, and they pulled back. Hit it again, pulled back. Hit it again, pulled back. And we stayed off of that ever since. What's interesting is the trajectory and the way that the traders trade. And you got to kind of understand the mindset of a bond trader, where they're going to buy and where they're going to sell. I built this channel way back early on, and I'd left this channel up so my YouTubers can, subscribers can see this channel and the movement. What's crazy is I built that channel, I left it alone, and I showed the exact same trajectory in today's trading of the security. So we're following the same pattern. So when you look at it, it was, I'm going to go back to the full size. So look at this as kind of like you're skipping a rock across the pond.
Yep.
Oh, geez, I just moved that. I'm going to
undo.
I got to undo that. Well, I'll come back and undo it. I'll just cancel this thing out and I'll reload it later. So if you look at this chart and you consider that, here you got the wind up and the throw, and then it skips and it skips and skips. It's going to settle, and it's going to settle deep. So what this tells me is we're probably going to see interest rates going higher for longer. That's my opinion of what I'm staring at here with these pools. So why is that something that people need to understand? If it's going to go higher for longer, they want to know should I be buying investment properties? So we all know the name Warren Buffett, right?
Right.
So Warren said the 30-year fixed mortgage is the greatest financial instrument in history because it's a one-way bet. If the rates go down, you just refinance if you feel you need to. If they go up, you protected yourself from rates going up. His business partner, Charlie Munger, who recently passed, said in a CNBC or MSNBC, I can't remember which one, interview in early 2023, that he said he and Warren believe that since we have seen 40 years of declining interest rates since the 70s, that we believe that we'll see 40 years of increasing interest rates. So why is that to understand and digest? And that's what we've been following, is as a real estate investor gets in today, they're going to be able to acquire a rate today for that 30-year fixed and be able to set that. Why are rates going up? They're really going up because of inflation. Inflation is the biggest pusher of everything. What is the true rate of inflation today? The real rate of inflation is probably somewhere close to 12%, not the percent that the Fed's talking about, because they only look at specific things. They only look at certain things and how they move, and they're the things that move the least because they're durable items or longer term items. So understanding that, when you pay money on something for a long period of time, you're actually paying less than what you borrowed. So it's good for a person to understand the real value of real estate. So let's do some quick math. And this is what I want to help everybody understand, is that when you're buying investment real estate, where its real value is, that's not the cash flow comes in. That's a great thing, but that's a vanity metric. Yep. So Andrew, I'm not going to ask you to do the math. I'm just going to tell you guys, and you can pause it and verify my math. Because typically I make you do the math with me so we can sync our brains up and people can follow along. But I want to go quickly that people can get through all of this. So let's say you're buying a $200,000 single family. And I encourage everybody to look at single families. 44% of the single families last year were bought by the hedge funds.
Yes.
60% of the available single family housing will probably be controlled by the hedge funds by 2030. You got to have single family housing. Otherwise, your family won't have anything. So if you have a $200,000 acquisition and you put 20% down, that's $40,000. Now, let's say in this environment, rates are going up, costs are going up. I'm going to hit you with an ugly number here. This is not the real number, but let's go with an ugly number for the sake of the math. Let's say between lender fees, title fees, appraisals, taxes, insurance, points, all these things, you're paying $10,000. That's $50,000 investment, $40,000 down, $10,000 in costs and fees and all that kind of stuff. So but you're getting a $160,000 loan because it's an 80% loan, 20% down, 80% loan, $160,000 loan. Now, if you do your job right, which is finding the right property to buy that stays reasonably rented the entire time you own it, and you can raise rents on it, who pays off the $160,000?
The tenant.
The tenant. So what you do is you take $160,000 divided by 30, which is how long it's going to take the tenants to pay this off. You will find that's equivalent to an average, and we're doing the average, not an amortization schedule, average of $5,333.34. Do the math. 160,000 divided by 30. That's how many years we're going with. That means your tenant is averaging over 30 years, giving you $5,333.34 by paying off your mortgage. Well, if you invested $50,000, they're giving you $5,300 a year. That means you're getting 10.6% of your money back every single year. That means your $50,000 investment is growing by 10.6%. That's significant.
Yeah.
Now, since we live in an inflationary environment, these property values are continuing to appreciate. Case Shiller, Black Knight, and CoreLogic said about 6.9% last year was the average in the United States. So let's say for you, the purposes of this, we're only going to say 2.5%. Because if you're buying in a place that you can't get 2.5% in appreciation on the home, you're buying in the wrong damn place. Look at where you're buying, right? Don't buy in these places where people are trying to get out of. So 2.5% of 200,000 is equal to $5,000. Take 200,000 divided by 2.5 or multiply times 0.025, you'll get $5,000. That means just by owning the home, it's appreciating by $5,000, which is equivalent to 10% of your investment of $50,000. You're making 20.6% return on your investment by doing nothing but acquiring it and making sure it's a place people want to rent and keeping a good property manager. That's not any cash flow. I'm saying if all your cash flow got eaten up to maintain it, your business is making 20.6%. That's significant. Now, let's get into that cash flow piece. Let's say it's renting for $1,800 a month, and you're getting $100 a month cash flow. No investor likes that figure. They'll look at that pro forma and say, this sucks, I don't want it. but you get to raise rents. The rents across the country are going up somewhere closer to 6 to 6.5%. Let's say you raised it by 3% of $1,800. First year's rent's $1,800. Raise it by 3%, you're talking about $54. Nothing exciting. No investor gets excited about it, but the bonus is no tenant gets excited. Like $54, I don't care. My cousin's got a 2-bedroom apartment. They raised it $200. So they feel like a rock star because they only got $54. But your cash flow just went up by 54%. Think about the compound growth of that cash flow in that first 5 years. It gets significant. But here's where it's really, 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 really sexy. Now, I'm going to talk a little bit more about this inflation thing just a second before I get into the best part of the deal.
Yeah.
Back in the early 1920s and before, they minted a $20 gold piece. I actually happen to have one. I just didn't have it out here. I'll show you. And you could walk into a department store and get a hat, a suit, a tie, a shirt, a belt, a pair of socks, and a pair of shoes with this $20 gold piece. Andrew, can you walk into a department store and get a pair of socks for $20 today?
No.
Practically not. Not good socks, right? Yeah. But here's what you can do. You can buy everything I just told you with an ounce of gold. What's interesting about this is the gold has not gone up in value, and those costs, those clothing that I just laid out has not gone up in price. What's happened is the value of the instrument we're buying it with has gone down in value because it printed too damn much of it. Right. That's the difference. If you rolled into a time machine and went to Taco Bell in 1993, you would be able to go in there and get 2 bean burritos and 2 tacos and a drink for $1.99. I know because that's what I did. That's what I lived off of at one point when I was younger. You go in there and do that same thing now, you'll find it's $15. Why? Because the U.S. dollar's lost that much value. Now, why is this a benefit to you? If you locked in a payment on this mortgage for the next 30 years, this $160,000 loan, you would pay over that period of time $407,000 in principal and interest payments. It's actually $407,689.20. That's what I have in front of me. That's a principal and interest payment of $1,132.47 at today's rates. But what's interesting about that, every time you give the lender $1, it's worth less and less and less and less. So as you're raising everything, they're getting less and less from you. When you recalculate the value of every single dollar that you gave to that lender to pay that back of your tenant's money, you paid $154,336.97. You paid them less than what you borrowed. Now, look at how powerful it is.
Wow.
So if you are not focusing on single family, you're missing out, and they're going to take it from you. So I am very earnest in buying these and putting in my family trust so my grandkids have a shot. Otherwise, they don't.
Yeah, right there, I 100% agree. There's no chance of people getting in right now to do this with.
And let me tell you one other quick word of caution, everybody. If you're waiting on the sideline, you say, well, the lenders say the rates are going to go down, or they're going to drop the rates, or the Fed might drop the rates. Quit that thinking. What do you think the price of housing will do if the rates actually did go down?
Yeah,
which I don't think
you won't be able to afford it. It's going to shoot up.
It's going to spike up. We have seen the biggest spikes in housing prices ever when the rates were down. Waiting for the rates to go down means everybody else that's waiting is going to jump in. Do not wait. If you're remotely thinking about it, call us right now. Go to aaronchapman.com, set up a time. We'll talk about it. We'll get you qualified. We'll set you on the path to finding those deals. And we've got them all over the place. I got a lot of great people we work with.
Yeah. So how does someone who maybe is just getting started, like, I want to do that. That makes sense. The math works. I have no idea how to buy a house as an investor because maybe they've never owned a home or only done it, when they live in it. Because it is different. I know, it's not that big of a hurdle to jump, but what would be the tip for those folks?
Honestly, you have to call me. Yeah. That's the absolute best thing. The thing about my industry that I love about it is it's full of predators. The thing I hate about it is it's full of predators. The reason I love that is because those some bitches, once you figure out they are, you leave and you go somewhere else. You find the one who's not. Now, there's a lot of great people out. I'm not saying that there isn't, but they're here to bread their table. And here's the thing. The average person in my industry does between 0 and 2 transactions per month. That's what the average person does. If you just call the guy down the corner and say, I'm going to buy an investment property, and you get this property and you find it on your own, and you get the inspection and the appraisal done, and you're like, I don't want to buy this thing. This is a pain. This sucks. I'm going to call my one guy that I trust from the mortgage and say, hey, what do you think? What do you think he's going to do if you're 50% or 100% of his income that month?
Oh, yeah. He's going to talk you into it.
You can do everything you can to make sure he can bread his table. Yeah. Now, you call me, I do 60, 70 transactions a month. I'm not saying, and I'll talk to you. My team will talk to you. We built it so we can talk to you. Yeah. We will give you everything that you need to question, decide for yourself, and we will back you up in your decision. Because if you fail, I start to fail, and I violently oppose failure. I can't have you fail on the first deal because you're not going to get to number 12. I don't give a shit about deal number 1, 5, 7, 9. I care about 12. Because if you get 12, you now have a future. If you get 12, I have a future. Yeah. I have to have you get to 12. Now, the reason it's important to know that I got 60 transactions closing, because if yours doesn't, I can still bread my table. I can still pay my bills. I don't have to talk you into anything. I'm here to ensure that you get there safely and that you continue to build that future. Because if your future is built, my future is assured. Yeah. You can't have that fall apart. So I tell everybody, just text me. 602-291-3357. That's my personal freaking cell phone. 602-291-3357. Text me and say, Aaron, I heard you on Andrew Lucas's podcast, the Deal Finders podcast. Can you set up a time to talk? I'll shoot that to my assistant, Bree. She'll get you on the phone and set it up to match your calendar.
Absolutely. Here. And y'all, he's not lying. He will. He will answer the phone and he'll get you in the right place. I know that, we've talked about deals. Again, you do it all over the country. I value so much of maybe it is the fact that you don't need this one deal, so that you're able to give that free opinion of what do you actually see here, not of the sales pitch of go close that deal. And that's one of the things that we do with our local community is we partner with people, and like you said, it's not if you fail on 1, 2, or 3, you'll never get to 10 or 12 where that real financial freedom sets in and you really become, a real investor that's now giving back and supporting their family, their community. So that's our goal. That's our focus here locally, is to get people to 1, 2, 3 and beyond. And so these connections with people like you that are building teams and helping people get through these deals is so, so important. And I wish we could sit here and go longer and deeper into this, but I've got to ask one question for so many people out there that don't understand mortgage rates and how they are related, and why do I look at the news and it went up and it went down, it went sideways? Like, what's the behind the scenes? Just give everybody kind of a sneak peek. I know you don't have time to go through the whole thing, but
I mean, really, it's what you have to look at. What is a trader who's taking a large chunk of money going to invest their money into for a return? If they're going to invest into the stocks, then more than likely interest rates are going to go up. Because that means the economy is doing well and people can afford more. If the economy is doing worse, they might go into the mortgage-backed securities and rates will come down because they're putting it someplace they're going to get a flat rate of return. So if you're investing money, you're like, okay, I want to be sure my money's safe. I have say $1 million. I'm going to invest it where I know I'm going to make a return all the time and limit the chance of risk. Well, right now the economy is doing awesome. I can put it into this index fund that's going to keep climbing up. But wait a minute, I just heard the economy's flipping. We just had this go on. Things going to explode. The economy's going to get hurt. So I'm going to pull all that out and put it into bonds because that's a flat set rate of return for 30 years. So I'll get my 5.5% every year for 30 years. And then I'll jump in someplace else. Now, those people who trade in those bonds, they also realize when inflation is up, means the value of things are going up, the places you'd want to go to invest in the stocks, that's eroding the bond because the bond's only making 5.5%. But the dollar is losing 8% of its value at the minimum end every year. Yeah. So why would you invest in a 5% return when you know your dollar is losing 8% of its value? You got to put it someplace else where it might grow. So in an increasing market, an inflating market, you go into stocks or some other commodity that will grow. When it's starting to deflate, you go into bonds, and that's when the interest rates go down.
Yep. So yeah, I'm so glad you put that into words for so many people that really just don't understand this, and obviously that's not enough to really get a full picture of it. So
no, there's a lot to it. You got to feel like a bond trader, and I even day trade options just so I can understand the market direction.
I love it. Yeah, Aaron, this has been amazing. And you gave your phone number, you gave a website. We'll make sure to put that in the show notes. So if y'all do want to reach out to Aaron, please do. His team can help you close deals and give you some guidance on, why in the world this might be a good deal versus, what you should run from this. The numbers don't make sense. This is not a good idea. So, Aaron, I appreciate that so much. And one thing for the new folks, the ones that haven't done a deal, what would you say their first step or, what should they do when they're looking at these deals? What would be one piece of advice to leave for them before we get out of here?
Find your team, then know what you can do. Don't go in there wishing, one, and know exactly what you can do. And the only way to know that is to work on the financing piece initially. That will tell you what you can do. And guys, the math I gave you about what you're really paying with the devalue of the dollar, you gotta take my word for it. I got a calculator that you can calculate that with. I had an app created just with that number off an algorithm created by the professor of accounting at Kennesaw State University. So you've got the app.
Yep.
When you contact me, just say, send me the information on how to download the app. You can get off the App Store, but also we'll send you the videos on how to use it.
Yep. Awesome app. It is great. All right, guys, this has been fantastic. And please do reach out to Aaron if you need his contact info. Again, let me know. And guys, when you're out there and you're trying to figure out if this is the business you want to get in, if real estate has been kind of the bug in your ear and you just don't know how to get started, join our local community. Join your local community if you're not in South Carolina. We're at dealfindersclub.com, but find the local meetup so that you can get around people and start to understand what the market is in your area and reach out to professionals like Aaron. I'm always happy to help you get connected. And so you can learn the business and then build. All right. So Deal Finders Club is there for you. Aaron is there for you. And we're right here on this podcast every week. So come back to the next one. See ya.
Thanks for listening to the REI Deal Finders podcast. You can find out more and apply to be a part of the REI Deal Finder community at reidealfinders.club.